Welcome to Saturday. We are talking about money. And today's a very special day because I want to introduce you to the future of Adams Financial Concepts. I've been doing this, I've been managing money for 36 years. That puts me in a very special category for money managers. I've been around a long time, but that's probably not going to continue for the next 30 or 40 years. So I want to introduce you to part of the reason that Adams Financial Concepts is probably going to continue. A person who I think has the potential to be a star advisor. So I've been managing portfolios for 36 years. I post my client returns. We've been beating the Standard & Poor's for a number of those years. Actually, since Adams Financial Concepts has been founded, we've been beating the Standard & Poor's 500, not every year, but in total we have been. And before Adams Financial Concepts, those are results which I cannot verify, but I did it then too. But if I look beyond that, we don't do financial planning. We look to protect assets. We look to enhance assets. We look to mitigate the unexpected and help clients make a difference in the world and community. And I don't talk much about that, but it's a big part of what we do and will be doing. And while I'm not going anywhere, I have no intention of retiring. There are 3 young advisors who have joined Adams Financial Concepts, and you're going to be hearing from them as we go forward. And it seems only appropriate, since I'm talking about the future of AFC, Adams Financial Concepts, is me to talk about the future of the economy and the future of where things are going. COVID-19 has been a major disruption, the pandemic. I like the thing that American Funds put out. They called COVID the Pearl Harbor moment. And I agree with that. If you look back, 1941, 75% of the artillery was horse-drawn. It was human power, horsepower, that drew the military, or drew the heavy artillery. They used to have a room full of people who used to sit and calculate how to aim the guns. They would take into account the weather conditions. They would take into account the distance. They would take into account all the factors that went into aiming the guns to fire accurately, to fire the very big guns. And those people were sitting in that room, and the military came to a company and said, can you make a machine that will do what those people do? And that company said, yes, I think we can. And in 1943, the chairman of that company testified before Congress and said he thought that probably there would be a market for maybe 4, maybe 5 of those machines into the future. Only 4 or 5 of those machines. Well, you know, the name of the people sitting in that room who were calculating how to aim the guns, they had a job title, and that job title was computer. And that machine became known as computers. And the company, of course, was IBM. And they made quite a few more than 4 or 5 machines. But that was the Pearl Harbor moment. That was putting us into the war. The military looked at things, and it made dramatic changes that we're seeing really happening today when you think about all that's happened. COVID may be such a major disruption, it could be equivalent to the Pearl Harbor moment that we saw in 1941. Going to be major changes in technology and demographics and lifestyles. It is going to be the century of biology. When I think back, the 19th century, the 1800s were the century of chemistry. You saw oil, you saw aluminum and steel, and all the things that were chemically bound. The 20th century, the last century, the 1900s, that was the century of physics, with flight, with electronics, with the internal combustion engine, with all the things that were derived from physics. the 21st century is a century of biology. I mean, we just came through the pandemic, and viruses do damage. When you think of a little virus that had 23 pairs in their makeup, humans in their DNA strand, humans have over 1 billion pairs. A virus had 23. If you look at the length of the DNA, if it was a string, it would stretch from one side of the country to the other side of the country. That's what the DNA was. It was a huge string of pairs, and the virus just had 23 pairs. And the virus enters into a cell. It uses the cell's architecture and the cell's own machinery to replicate and to grow and to create more viruses, which invade other cells, take over their machinery to work. Think of what we learned from the coronavirus. We learned what it could do. Think of the future. In the next 10 or 15 or 20 years, people will be continuing to work with viruses and beginning to look at viruses and how they can control those viruses. There'll be newly formed viruses that we actually form in a laboratory. Viruses get twisted. Our cells, the DNA, gets twisted. You can see it's called a double helix because it wraps around. That's what a virus has as well. It's twisted in either to the right side or to the left side. Think if we can make a mirror image of that virus, of those 23 pairs, make it a mirror image and attach the mirror image to that virus, we would effectively destroy the impact of that virus. It would attach to its mirror image and never enter into a cell. Those things are being worked on, and they will come. That's just on the viral side. But think of all the other things that are going to happen. Probably in the next 10 years, we'll probably see a cure for cancer. We may see progress made to reduce heart disease and maybe eliminate heart disease from biology. And that's something that is happening in the next 10 to 20 years. And we're going to live, and those are going to create opportunities for investment. We're going to see people live to the age of 125 and maybe to the age of 150. Carnegie Mellon University built a heart. They 3D printed a heart. It's not made of plastics. It's not made of metal. It's made of human tissue, and it's been 3D printed, and it works like a heart, and it has all the components of a heart. Now, it's still not the perfect heart. It's still not the perfection that our heart was made, but it gets us awfully close. Think of beyond, but biology is going to go way beyond healthcare. On the program a couple times, I had the Blue Marble Company, and Blue Marble took the bacteria from the stomach of a whale, which eats plankton and algae at the bottom of the ocean. They combined it with the bacteria from the stomach of a cow, which eats grasses and grains, and they made a new, I said virus, bacteria. They made a new bacteria. And that bacteria, they designed to deal and make petroleum products. Now, in the beginning, they had this idea they were going to do biodiesel, but they realized very soon after they started that biodiesel is a low-margin, high-volume product. They needed to make a low-volume, high-profitable or high-margin product. And if you look at a tube of toothpaste, it has 4 or 5 or 6 different petrochemicals. It took bacteria a couple million years to manufacture the oil in the ground. For Blue Marble, they're able to manufacture a number of petrochemicals in a couple days. They take what's left over from brewing beer or from canning tomatoes, that pumice, and they take what's rejected from canning tomatoes, and that's normally sold to farmers as fertilizer for $150 a ton. Blue Marble can take that pumice, make 28 different petrochemicals from it, and sell it for the equivalent of $28,000 a ton. That's part of what it is. Mohawk Industries introduced a smart strand in their carpet line, a petrochemical that's manufactured, and it replaces some of the carpet material. And it does it by saving huge amounts of actual petroleum product. We're coming to a commercial break. Don't go away, because I want to come back and talk about what's happening in the next 10 years. And I want you to meet one of the new advisors at Adams Financial Concepts. That's coming right after the commercial break. Don't go away. We are coming along. We've got so much to talk about. There is so much going to be going on. There are going to be so many opportunities coming up in the next 10 years. It is going to be a great time. So welcome back. I've been talking about the future, what's happening in the next 10 years, 15, 20 years, the opportunities there's going to be for investments. One of those opportunities I talked about was biology, and that's going to be a significant impact in the next 10, 15, 20 years, maybe for the next 40 or 50 years. But a second area is going to be robotics. Right now, it's the leading development of that is happening in Japan. It's continuing to happen in the U.S. It will continue to accelerate in the U.S. In Japan, it got started because the average age of men in Japan is 80, women 87. That's expected to grow, and their people are getting older. Today, 25% of the Japanese are over 65. By 2050, it's approaching 40%, and the U.S. is headed that same way. And in Japan, they felt that they're going to need to have caretakers for the older people. It's a low-paying job. It's a high turnover with a lot of injuries. And so Japan started the whole focus by focusing on robots, almost like the 3CPO and R2-D2 type of robots. But they're the future caregivers. Japan feels that they need 4 million caregivers by the year 2025, and now they have less than 2 million. But the future caregivers, not going to be humans, they're going to be robots in large part. Toyota's developed 4 types of robots today, what they call the HSR, the human support robot. They can assist in nursing. They can assist in independence in daily life. They can pick up and carry things. They can pick up individuals even. They can do preventive care. They can do health maintenance. They can take care of homes of people with disabilities. Those are robots that can do housework and do the things around the house. They also built a social robot to monitor the health of the aging of their elderly people, to engage actually in conversation, and to look right now, they look right now like a teddy bear because they're cuddly. Because who wants to cuddle up to an R2-D2 or a C-3PO? They're metal machines. But those are machines. The social robot is a cuddly. It doesn't even have a metal exterior. And they do preventive care for the elderly people. They've got a rehabilitation robot, the WeWalk robot. It's designed to assist rehab in leg paralysis due to stroke or other types of disabilities. It's an assistance based on exercise and learning theory. They adjust, and the robot is able to adjust to a specific course for each one of the elderly patients they have, and they'll give feedback. It's easy to use. And they have a 4th robot, the THR3, which has fingertip control. It can play the violin. It can play the trumpet. And it's all about being controlled. They can do the dishes. They can provide entertainment. They can do housekeeping. They can even take care of some grandchildren. Honda has a robot called a Simo. It works on voice commands. It shakes hands. It can bow. It can actually take an elderly patient out of the bed. It can actually help toilet an elderly patient. It can recognize moving objects, and it understands its environment. It actually interacts with human beings. And Tokai Rubber has one that will lift people up to 175 pounds, and it will probably even be built to lift people several hundred pounds. 310,000 robots being built, and it's just beginning. The Kangaroo Group at the University of Tokyo has built a robot that's 5 foot 6 inches tall, weighs 125 pounds, has 160 motors, can mimic human motions, can do push-ups, can do pull-ups, can do back bends, and 6 times the degree of movement compared to humans. The robotics are coming, and those are going to be opportunities for investment. But maybe the largest potential investment potential is just beginning, and that's the greening of the world. Energy is a $10 trillion industry. $10 trillion. When you consider that the entire media industry, that's this radio program, that is movies, that's books, that's paper, everything to do with media, that entire industry is $1 trillion. Energy is 10 times larger. Oil has been the biggest and most powerful industry in the world, and it's not going away willingly, but with what we've seen in the last couple weeks, the last few days of what's happened with oil, Royal Dutch Shell being told that they have to reduce their emissions, their carbon emissions by 45% by 2030, by 2 directors being elected to the board of Exxon, activists that want to see Exxon change direction, the shareholders passing a resolution for Chevron doing the same, and the most influential association in the world, the International Energy Association, which was founded by Kissinger back in the 1970s, that association has said no country should ever again approve an oil production facility. Those are some very significant things. I talked in this radio program some weeks ago about the difference of the approach of Exxon and BP. Exxon both felt that energy was going to continue to grow, which is going to be no question, but Exxon said that 50% of energy will be supplied by oil. BP said we're in a state where oil is at its peak, and from here it's going to continue down, and oil is going to furnish less than 10% of the energy in the next 30 years. The global energy demand is going to continue to grow, but it's going to be driven by emerging nations. The demand will grow, but fossil fuels will continue to decline as they're replaced by renewable energy and nuclear. That there'll be a transition to lower carbon energy with greater consumer choice and an entire restructuring of the global energy system into low carbon sources. Oil demand is going to decrease, and it's going to continue to decrease with the greatest consumers of oil being gasoline, with the shift to electric vehicles, with the shift to automated vehicles, and there will become a time when maybe no one will ever own a car. We'll have to see. Natural gas will be more resilient than oil in supporting those economies, but natural gas emits methane, and methane is negative for the atmosphere as well. That's going to be a source. As we improve battery technology, we may see the disappearance of natural gas consumption as well. The use of hydrogen will increase, and bioenergy, biofuels, biomethane, biomass is going to increase as the world shifts away. The world is really on an unsustainable path, and we're seeing that with what's happened recently in the fossil fuel energy. That's happening, and that's going to be happening for the next 10 years, 15, 20 years. Lifestyles are going to change. Work. Factories are going to change dramatically. We've seen the rise of 3D printing, where it's customized to individuals. It's going, instead of mass producing things, we're going to see more and more individual production that's going to suit individual people. Assembly lines, when they do exist, are going to be based on robotics. And we're going to see more and more customized and robotics with programmable chips being able to produce an individualized product rather than a large assembly line product. There's going to be factories that specialize in small production and flexible factories designed to produce an ever-changing range of products. Think of what's happened with smartphones, with tablets, with TVs. That change is happening faster and faster, and successful factories will change very, very quickly. We're going to see flexible factories that build things for others, and factories that are really going to be disruptive. We're going to see tremendous changes in what we do in terms of remote. Zoom is just one of the tools, but we're seeing some of the things change with remote work, with gig workers. We're going to see changes in entertainment. Cash may disappear. Food delivery is going to disappear. It's going to be telemedicine and travel. All those things are going to be affected in the next 10 to 15 years. Truly, COVID may have been the Pearl Harbor moment. It may be as effective as World War II was for changing technology and lifestyles. Richard Foster Vail said the companies in the Standard & Poor's in 1920 had an average life of 70 years. Today it's 15 years, and we could see companies only last 4, 5, or 10, or 15 years. It's going to be a tremendous change. There's going to be tremendous opportunities. And for that, looking forward, we want to be ahead of the curve instead of behind the curve. We want to see what's coming and not what's been. We want to be in what's happening and not what is going away. That's the focus of where we need to be and what needs to happen. That's where we are. That's where we are at AFC. That's where we've been, and that's why we produce the results we do for our clients. That's what we want to do, and that's where we're going. That is our story. And to go along with that story, we have some new advisors that have joined us. You're going to hear their stories over the next couple months. You're going to hear about them. You're going to hear about what they're doing and why they are going to be the rising stars in the industry. Don't go away, because as soon as we come back, you're going to hear from one of them. I'll be right back after this commercial break. So, welcome back. I want to introduce you to Chris Cyand, who is one of the people I think is going to be one of the superstars in the industry in the next decade, 2 decades, 3 decades going forward. So welcome to the program, Chris.
Awesome.
There,
thank
Chris?
you, Mike. Thanks for the glowing introduction.
So, Chris, why don't we start with your background before you got into the industry?
Yeah, absolutely. I would say my love for this industry started at a young age. When I was about 12 years old, I don't know how many of you are familiar with the OMSI, but it's the Oregon Museum of Science and Industry down in Portland. And just as a young folk, a little 11-year-old, they had a stock simulator in there, and not really knowing what's going on, being young, I just walked up and started to play with it. And next thing I know, I saw a lot of green on the screen, and I liked what was going on, right? And so I remember talking to my mom at a very young age, asking, what's the youngest age of an advisor? And, of course, that she kind of brushes that off and, said you have to at least be 18, blah, 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 blah. I ended up going to school here in Washington State, go Cougs. And throughout my time there, I'd say that's really when I started to learn about the industry and get more of a working knowledge. I was able to start investing throughout that time. At this age, you can just trade using your smartphone. And so during classes or, going home or whatever it may be, I just found myself trading. And next thing I know, I was actually getting to the point where I was paying some of my bills doing some of these trades, especially with derivatives. And then from there, I realized, wow, this is the industry that I want to be in. This is something that I really enjoy doing. And so I got my start in a pretty large investment advisor firm before ultimately settling down with you, Mike, here at AFC.
So, talk about your outlook on where things are going.
Yeah, I think we're in a super cycle right now. You've mentioned this on a few programs, but I think especially with energy where it's at and what's coming, I think that we're going to be in the next industrial revolution of the energy. Yeah, things are, Mike, you had mentioned the IEA earlier and how really there's going to be no more approved drilling facilities for oil, and it looks like oil has hit its peak, and so it's all going to go somewhere. Something's got to power the grid, and I think that's going to be electricity. And so if we're at this age where everything's going to have to start transitioning, and quite frankly, I think that's going to be lead to a great opportunity for investors.
And you're ready to take on new investors and bring people into the fold, right?
Absolutely. So, Mike, let me ask you this: how did you get into the advisory business?
Oh, that goes back a long ways. I mean, I started my career in the aluminum industry. Way back in 1967, I got my MBA from Carnegie Mellon, my undergraduate degree in math from Oregon State, my MBA from Carnegie Mellon, and started at Intalco Aluminum up in Ferndale. Was one of the up-and-comers. They sent me to France for a year and a half. And I got to manage people, and I got to learn about management. I got to learn about improving production quality. I think one of the things that happened at that point, the president of the joint venture, I was his assistant for 6 months. And one thing he said to me is, there's only two ways to succeed in business. One is to be the greatest politician, and two is to be the very best at what you do. And I realized that I probably wasn't a great politician, so I really needed to be the very best at what I could do. So actually, as I ran the plant, we actually built the plant that was the most efficient, with the highest quality, with everything worked well. I cut the workforce by 30%, increased the production throughput by 20%, increased the quality of our product, all of those things. And in doing so, I felt that I wasn't getting paid for what I should have gotten paid for, so I left Intalco to start a milk tank business. And dairy farmers milk a couple times, 2 or 3 times a day. They milk into a stainless steel refrigerated tank. I bought a small company in Linden, Washington, and built it up and down the West Coast. We became the largest in the world, and I was expanding 77% a year. And to do that, I was borrowing money from the banks. And when the bank hit their difficult time in the oil patch in the 1980s, they came and they called my loan. Every time I had walked into the bank prior to that, they said, "How much do you need?" And then they would give it to me. And this time when I walked into the bank, they said, "We're calling your loan." So we actually went through a process of liquidating, and I never filed for bankruptcy, but we lost essentially everything we had. And I learned from that experience. I learned, one, how to read a financial statement. Two, I learned that growth comes from either earnings or borrowing or selling capital stock. And the danger of 2 of the 3 is that you owe somebody else your growth. If you can borrow, if you need to borrow money, or if you need to earn it, it makes a huge difference in how companies grow. So if you look at the stocks in our portfolios, earnings is a crucial factor, the cash flow. The balance sheet is crucial. And I've carried that into this business. And when I started in 1986 and licensed, I was a stock jockey. Back in the days of stockbrokers, when we would call people up and would say, I recommend a stock or buy a stock or whatever. And it was a situation of, if you didn't make money for people, they found somebody who would. That was the type of business that I grew up in the 1980s and early 90s. The fee business was new when I started. I was one of the very first to do fee-based business when I started my fee-based account. My first account was on December 31st, 1990. That was my first account, and that client is still with me, as are most of my fee-based accounts. But it was completely new. The old idea was to pitch a stock and to build positions. That's how I began in this business. But I realized I had one stock which I couldn't come to selling. The idea was to build a position in a stock when it reached a certain price to sell that and buy a different stock. But there was one stock in which I couldn't bring myself to sell. And I came to the conclusion that I'd really like to get paid for keeping people in stocks rather than commission in and out. And that's how I really got into the fee-based business. So anyway.
Yeah, and I know you had talked a lot about in the past about, selling the relationship, not the returns. I mean, that was a point of emphasis. And, and how, I guess my question would be, can you talk about how, staying in stocks versus, actively trading on how that's changed and how the industry has changed from, selling the relationship to, to actually selling the return? Like, how does that change?
Well, back in the transaction business, the big question was churning accounts. Just, there was an old phrase in the brokerage business, 10% or 15 days, whichever came sooner, because you got paid every time you sold a stock and bought a new one. And with fee-based business, that really began to change because it didn't matter how many trades you made, you got paid the same fee. But the performance, whereas in transaction business, if you didn't make money for people, they found somebody who would. And the turnover was huge. In the 80s and 90s, the number of people changing accounts every year was like 20% of your book. I used to look at my book and I had about a 10% turnover rate. 5% of people would pass away, had reached the end of their life, but the other 5% were moving or whatever. But people moved on. But as we shifted to a fee-based business, performance became less, and firms began to push the idea of sell the relationship, not the performance. They put the emphasis on connecting and liking the advisor rather than on how well the advisor did for the clients. And I think that's led to advisors not trying to excel at production, but trying to excel at building the relationship and building all the tools to help create that relationship. That's a huge change from what happened in the 1980s and 90s to what happened today. So we're coming to a commercial break. Don't go away. I want you to hear more about Chris, more about what he's doing, because you get both of us with Chris. So don't go away. I'll be right back after this commercial break. And if you miss any part of this program or any part of the other programs, you'll find them on YouTube. You can click on About Money, go Google YouTube, About Money, and you can find this program. You can find the other program. You'll also find on podcast on our website these programs as well. And you can also sign up for our newsletter. We have about 4,500 people that read our newsletter now, or receive our newsletter. You can write to Adams Financial Concepts and receive and sign up for our newsletter. Don't go away, because we'll be right back after this commercial break. So welcome back. I'm here with Chris Cyand, who I believe is going to be one of the superstars in this business. Already he's starting to learn about the stocks and the business that I do. There's a transition that's going to take place where he's going to understand everything that I do, and he's going to improve on it, I'm sure. But even now, when you connect with Chris, you're going to get us as a team. You'll get both of us. And you'll get to know Chris better, and he'll get to know you. He'll get to know your needs, your desires, and how we can deliver benefits to you. So talk more about that, Chris.
Yeah, absolutely. I think, Mike, the thing that I'm going to really bring to AFC is going to be, just a long duration. I plan on, retiring from here at AFC and learning everything that you have to offer. When you get someone with, over 35 years of experience, working side by side with you and teaching you the ways and teaching you, the sauce, as we say, it's an honor, but it's also it's a little bit nerve-wracking as well. When you have a lot of clients that are trusting you with their life savings, the savings that they've been working their entire life to earn and to have. You want to be very prudent with that, and you want to be able to grow it, but also not screw it up. And so, luckily I do have some time to learn the formula. No one's expecting me to start picking stocks tomorrow, but, I'm certainly really excited to be learning from you in the future, and especially going forward. So I guess that would lead me to ask you, Mike, how did you get into picking stocks? Obviously I've started at a young age and have, a lot of interest, but what got you into it?
So I had started to pick stocks when I had the dairy tank business, actually when I was working for the aluminum company. And during that period of time, I started understanding a lot about stocks and about companies. When I started in the business, for the first 6 months you were in the business, you had to generate $21,000 worth of commissions in the first 6 months and $100,000 worth of commissions in the first year. And the big push was to do mutual funds, which were paying 8% commissions. And I did some of that in the first 6 months to get to my $21,000. And I said, if I have to do mutual funds for the rest of my life, I have no interest in doing this. I really am a stock picker and want to be a stock picker. And so I made my numbers. I made the Eagle's Nest, which was the top tier for rookie brokers or people in the business for their first 4 years. I made it with Payne Weber. And it became about stock picking. It's much like what you're learning to do right now. It's not about thinking about mutual funds because they're expensive, and the returns are not that great. It's something where the real thing is to understand what you're buying, why you're buying, and what the long term is. That's the difference between just being a financial advisor who recommends someone else's work and when you do your own work. That's where you're headed, Chris. That's what you learned, that's what you're doing, and that's what we talk about. We talked about that in our meeting this week. We talked about stocks and what stocks have been in the portfolios and why they've been in the portfolio. You remember that, right?
Mm-hmm.
So as we go forward, it's a transition period, and it's my favorite Impressionist artist is a person by the name of Camille Pissarro. People know Monet, people know Renoir, but my favorite was Pissarro, and maybe it was because of what he did. When he did landscapes, but when he saw a landscape and he saw a house and a tree, and he didn't like where the tree was in the actual landscape, He might paint the picture with the tree on the other side of the painting or in the middle of the painting. He would move things around. There may not have been a path. There was always a path or a road in his landscapes, whether they existed or whether they didn't exist. And he was one of the great Impressionist painters, recognized as like Monet and Manet and Renoir and so many others. But he didn't start by just picking up the palette and the paintbrush. He started to work with Jean Colbert or Corot, not Colbert, Corot. And Corot was also a landscape painter. And when you look at Corot's paintings, you can see where Pissarro picked up some of his technique from Corot. But Pissarro went on to improve upon it. And I believe that as you join Chris, you'll understand what I do, and you'll go on to improve on it. What I do, you will do so much better. That's the focus on where we're headed. For the time being, somebody gets both of us. In the future, they get somebody that's better than both of us. They get you.
Well, one can only hope.
No, that's the vision, and that's the focus on where things are headed and what they're going to be. That's, it's going beyond that. It's envisioning that and then making it happen. It's thinking about it, and it's then seeing how it can happen. And it's not an easy process. It's not a one-night process. It's not a process where we say, okay, we're going to do it, and the next day we do it. It's a process that's going to take 6 or 8 or 10 years, and maybe longer than that. And I'm going to be around for that, but so are you. And when I'm finished with it, you'll be doing even better things. And so people that work with you are now going to get the benefit of both of us, and in the future they're going to have the benefit of working with a real superstar. That's the benefit of a listener listening to this and a listener working with Chris. I think you get the benefit of both of us for the time being, and you get the benefit of working with a superstar in the future. You get, if you look at it, when Ken Griffey came up to the Mariners, he wasn't a superstar, but he learned from the other players. He learned from his dad. And at the end of the time, he had the 5th highest number of home runs in baseball history, was a true superstar. But he began, he learned, and the people who were with him during that time got the ride all the way. And the people that are with you, Chris, they're going to get a superstar in the making. I think they're very lucky for somebody that works with you.
Well, Mike, thank you so much for that. I certainly, I've always appreciated the confidence you have in me, and ultimately, I'm looking forward to continuing to learn from you, just because there's so much to know in this industry, so much to learn, and then ultimately where it's going. I mean, you see things like GameStop today, you see cryptocurrency, you see all of these crazy phenomenons happening, and it feels like they're happening even quicker. And so I hope to bring a young, fresh perspective to AFC, a kind of a word on the street, so to speak, that only a 20-year-old would be able to gather. And hopefully bring that and broaden our scope. So Mike, thank you for having me on.
Thanks for being on.